Which should you invest in, an apartment or a unit or a freestanding house? In today's video, I'll go through pros and cons of an apartment or a unit, the pros and cons of a house, and in the end, I'll tell you about my prediction for the rest of the 2023. Welcome to Real Money. I'm Khurram. If you're new to my channel, I'm real estate agent, entrepreneur, property investor, and developer, founder of Nidus Group Real Estate and H2O Loans. I have helped many of my clients, transacted over 1,000 properties. Through H2O Loans, we've helped clients secure funding for over $1 billion worth of real estate. If you really want to learn how to create wealth through real estate, hit the like button, hit the subscribe button, because this is what this channel is all about. I love getting the DMs from you through Instagram, TikTok, Facebook, and through this channel. So keep those questions and comments coming. It encourages me to produce more content like this to hopefully help you gain knowledge and create the positive mindset required to carve a successful life for yourself. Let's get on to it. First, let's talk about the pros of investing in a house. Number one. Historically, freestanding houses almost always outperformed apartments in terms of capital growth. Why? The answer is simple. Freestanding houses have more land to building ratio. It's simply because land is appreciating asset while building is depreciating asset. And with the population growth that we're experiencing, land has become more valuable because the demand for housing is growing. Ready-to-build land becoming more and more scarce, and this scarcity is what drives the capital growth for houses to be faster than apartments. On the other hand, the market for apartment unit has higher chance of oversupply. Oversupply can impact prices negatively because all of a sudden buyers and renters have more options, and you are competing with many other similar properties, which make it harder to extract premium price when there is an oversupply. Number two. Freestanding houses offer more development opportunity and flexibility. There is potential for subdivision and development, which means you can split the land and award each portion its own separate title. You can renovate, extend, and add second, third, or more dwellings, which are not available through apartment or unit. Number three. Freestanding houses tend to hold its value better during market downturns. And because typically apartment units is an entry-level dwelling for the most occupants, the churn rate for tenancy and ownership is a lot higher. Throughout my career in real estate, I have seen 3 market downturns, and each time freestanding houses sell outperform the units due to the few reasons. The buyers and renters of apartments are the bottom end of the market. Therefore, they are a lot more sensitive to changes in the economy. During market downturn, we normally see drop in demand for apartment and units. However, there are some cons of houses that you need to be aware of. Number one, higher entry cost. Across the capital cities in Australia, the cost of investing in a house is 28 to 38% higher than the cost of investing in a unit. Here is a comparison between median price of a house and median price of a unit in each capital cities in Australia as of August 2023. So if you are in Sydney, the deposit required to purchase a house is $100,000 higher than unit. That is significantly higher. Number two, the rental return or the rental yield for a house is typically lower. Here is a comparison between average rental yield of a house and average rental yield of a unit in each capital cities in Australia as of 2023. Number three, the maintenance cost of a house is typically higher than a unit. I would budget between approximately $2,000 to $3,000 per year for a maintenance of a house, and for a unit, I would budget half of that, just because you don't have the strata or body corporate to share the maintenance and upkeep responsibility. What are the pros of investing in a unit? Number one, lower entry cost. Number two, you are sharing the upkeep cost of a unit with all the other unit owners in the building. Each building will have a body corporate, and the body corporate collects sinking fund from all unit owners in the building. This sinking fund gets used to keep up with the maintenance of common facilities. This makes the maintenance cost of a more manageable and more predictable. Number three, you can accelerate the number of properties in your portfolio to a lot faster due to the lower entry cost and the higher churn rate, it gives you the ability to have a diversified portfolio and spread your risk instead of putting your eggs all in one basket. For example, instead of one house in Sydney, you can instead purchase one unit in Brisbane and one unit in Adelaide. So the same amount of investment, you can afford to buy 2 units instead of one house. Because of that, your risk is spread across 2 properties instead of one. Number 4, typically in a good market, it's easier for a unit to rent or sell because it's more affordable. There is more demand and it makes the market size for a unit slightly larger than a house. What are the cons of a unit? Slower capital growth. Unit growth have been lagging behind the house growth, and the data from the last 10 years supports that. Here are the growth of house versus unit from the last 10 years. Across the different capital cities in Australia, strata fees and regulations for apartments are often part of strata title complexes, which means you will be subject to strata fees to cover shared maintenance, insurance, and management costs. These fees can eat into your rental income and affect your overall return on investment. Additionally, strata regulations can impose limitations on how you can use or modify your property. Limited control. When you invest in an apartment, you are part of a collective ownership. This means decisions about the building's appearance, maintenance, and upgrades are typically made by a strata committee or body corporate, limiting your individual control over the property. Disagreements within the committee can also impact decisions that affect your investment. Market saturation and competition. In certain areas, there might be an oversupply of apartments, leading to increased competition for tenants. This oversaturation can put downward pressure on rental yields and make it harder to attract reliable tenants. High vacancy rate could lead to periods of negative cash flow, affecting your investment returns. Resale challenges. When it comes time to sell your apartment, you might face challenges due to market dynamics and competition from new developments. Apartments can have longer days on the market compared to houses, especially during periods of economic uncertainty or oversupply. This extended selling period can impact your ability to realize profits quickly. Considering all the points that we've discussed previously, I won't be excluding apartment or a unit from my investment strategy in 2023 and beyond. And here are my reasons. Number 1, increased migration. Australia's steady influx of immigrants has been a driving force behind the housing market for years. As the population continues to grow due to immigration, the demand for housing, including apartments, is projected to remain strong. Immigrants often seek rental accommodation upon arrival, creating a steady flow of the tenants and the first-time buyers, potentially contributing to the overall capital growth of the apartment sector. Number 2, baby boomers. Up to 4 million baby boomers will retire in the next 10 to 20 years. Apartments with their compact size and proximity to amenities are becoming increasingly attractive to downsizing retirees. Number 3, as house prices continue to climb, the appeal of an apartment as an affordable and pragmatic housing solution is set to grow even stronger. The trend of trading space for location and convenience could amplify the demand for apartments, driving their capital growth and solidifying their status as a compelling investment choice for both investors and homeowners alike.